Assalamualaikum warahmatullahi wabarakatuh. My name is Erlina binti Muhammad Azhar and my partner is Nur Kamarina binti Arman.
Okay, so I will explain to you about assertions. Assertions is the transactions include sales, purchases, and wages paid during the accounting period. Account balances include all the assets, liabilities, and equity interests included in the statement of financial position at the period end. If the auditor performs tests to confirm the occurrence of sales, this will also provide some assurance about the existence of receivables, although the auditor may perform other tests specifically focused on existence. Assertions have 6 classes of transactions and events and related disclosures for the period under audit. First is occurrence. What is occurrence? Occurrence is the transactions and events that have been recorded or disclosed, have occurred, and such transactions and events pertain to the entity. For the second is completeness. Completeness is all transactions and events that should have been recorded, and all related disclosures that should have been included in the financial statement have been included. For the third is accuracy. Accuracy is the amounts and other data relating to recorded transactions and events have been recorded appropriately and related disclosures have been appropriately measured and described. For the fourth, cut-off. Cut-off is the transactions and events have been recorded in the correct accounting period. For the fifth, classification. Classification is the transactions and events have been recorded in the proper accounts. And for the last one is presentations. Presentation is the transactions and events are appropriately aggregated and disaggregated and clearly described, and related disclosures are relevant and understandable in the context of the requirements of the applicable financial reporting framework. So, the assertion is related to the transaction and also related to the disclosures. But in the disclosure, we have different items, which is existence, rights and obligations, completeness, accuracy, valuation and allocation, classification and presentation. We will talk about this just for a minute or just for a moment. For this one is existence, which means the asset or liabilities or equity exists. For the rights and obligation, entity holds or controls the rights to assets and liabilities are the obligations of the entity. For the third is completeness. Completeness, as we will explain to you later, for the asset, liabilities, equities should be recorded completely. And for the fourth, accuracy, valuation and allocation, assets, liabilities and equity have been included in the financial statements at appropriate amounts, and any resulting valuation or allocation adjustments have been appropriately recorded, and related disclosures have been appropriately measured and described. Appropriately recorded and related disclosures have been appropriately measured and described. For the classification, assets, liabilities, and equities have been recorded in the proper accounts, just like the first one, like the transaction, it must recorded in the proper account. And for the last one is presentation. Presentation also like the transaction, it's just have the normal, like what we call it's the explanation is sent to the transaction recorded. Okay, so we will go for the interpretation of assertion and appropriate audit procedure. Okay, for the interpretation assertion and audit procedure, I will just straight away talk about the completeness. For the completeness means that transactions that should have been recorded and disclosed have not been omitted. relevant tasks that we can make it: select a sample of customer orders and check the dispatch notes and sales invoices, and the posting to the sales account in the general ledger. Okay, the difference in the direction of the above tasks. In order to test completeness, the procedure should start from the underlying documents and check to the entries in the relevant ledger to ensure none have been missed. To test for occurrence, the procedures will go the other way and start with the entry in the ledger and check back to the supporting documentation to ensure the transaction actually happened. So, totally about the completeness, they need to make sure that the transaction is actually happen and really happen, and they cannot state the wrong amount. Okay, that's all from me. So we will move to the next explanation about the completeness.
Today we will present to you about audit assertion, which is completeness. What is completeness in audit? The assertion that the financial statements are closed, and it includes any items that should be included in the financial statement for a given accounting period. It means any transaction that should be in the financial statement should be disclosed. It will be considered complete if all the transactions have been recorded. It means if the auditor did not recording any transaction in the auditing, that means the audit is not complete. How completeness will be calculated? For example, Axiata sales are worth 1.1 million in the financial statement. How will we calculate the completeness assertions? To test the completeness, how an auditor tests the completeness of the financial statement. First of all, we need a sample of customer order and match it with sales invoices and good dispatches note. We also need to check the sales that we're posting into general ledger. Why an auditor need to check everything? Because the client hired us to check and correct what they are wrong. We cannot put our personal interest in our work. In the financial statement, it must be true and fair view, because to ensure that the client are really satisfied with our work. So, for the auditors, we need to be an independent and trustworthy. Why should we test the completeness with the steps that I have given to you before? So let's find out why with me, okay? Firstly, this is because we need to trace the entries in the general ledger, the supporting documents to ensure that these transactions actually happen, which means an auditor, they need to gather all the evidence to support their auditing and to make sure that all the transactions have been made. Okay, for the second is we trace customer orders to its posting into the general ledger to ensure that transactions are recorded completely. For this completeness, we need to make sure that our customer have posting that into general ledger and the transaction have been recorded completely. Firstly, completeness assertions relating to transactions. All the transactions that are recognized in the financial statement should be recorded in the financial statement, which means all the items that have in the financial statement, such as inventory, account receivable, account payables, that all the items must be recorded completely, and then the evidence need to be gathered to give to the auditor to make their works more easier. Like the transaction, this is for the second, completeness assertions relating to assets, liabilities, and equities balances at the period end. All the assets, liabilities, and equities balances that have been recognized in the financial statement should be recorded in the financial statement, which means all the items need to be recorded completely and recorded with the accurate amount in the financial statement to make sure that the financial statement is presented in the fair view.
Last but not least, completeness assertions relating to presentations and disclosures. All the transactions, balances, events, and other matters that have been recognized in the financial statement should be recorded in the financial statement.
The completeness of transaction in the financial statement means all the transactions incurred during the stated accounting period are recorded in the financial statement. For example, the assertion of completeness also stated that the company entire inventory, even inventory that may be temporarily in possession of third party, is included in the total inventory figure appearing in financial statement. As we can see, the Axiata financial statements that has been audited, the inventory is amounted is maybe temporarily in the position of third parties is included total inventory figure appearing in financial statement. So as we can see here in the financial statement of Axiata that have been completeness because they record all the transactions incurred during the time period, all the transactions during the beginning until the end of the time period have been recorded in the financial statement.
In a conclusion, any of the preceding assertions are not correct. Then the auditors may need to conduct additional audit procedures, or they may not be able to provide a clean audit opinion at all. Why? Because in the audit opinion, the auditor must provide the true and fair view opinion for their customer.
That's all from us. Thank you. Till we meet again.